again. I'm Earl Dembath, your concheconomist, and we're continuing with our series of programs on home buying in 2026. This has captured the attention of a lot of people recently, including the President of the United States, who has set forth some proposals to help with affordability and increasing the supply of housing. We're going to be talking about that. My focus is going to be on first-time home buyers who are seeking to buy an existing home. Now, if you're in the market for a new home, that's a little different situation because there's not much negotiation with the seller. I call attention today to Fannie Mae, which is the nickname for the Federal National Mortgage Association, which was created in 1938 to provide support to the housing market. Basically, what Fannie Mae does is buy existing mortgages. When your bank or lender makes a mortgage loan to you, they use up thousands of dollars for that mortgage. So in order for them to be able to continue making mortgages, they sell that mortgage to an organization like Fannie Mae, and this replenishes their stock of funds then that they can use to make more loans. And the president recently announced a directive for Fannie Mae to buy $200 billion of mortgages. Now, what that means is buying mortgages and then developing these into something called mortgage-backed securities, and you've sometimes seen the acronym MBS. And they package these into bonds and sell the bonds, and that's how Fannie Mae gets its money. It sells bonds, gets money. With that money, it buys mortgages and so forth. So it's a rather involved situation, but it helps a lot. And by aggressively buying mortgages, when you're creating the demand for something by you're bidding up the price, and as we have seen in previous programs, there's an inverse relationship between price and value and interest rate. So if they can bid up the price of those mortgage bonds, they can help reduce the mortgage rates. In fact, we've already seen some indication of that, where as a result of the president's announcement, there has been some, at least a short-term dip here in mortgage rates, and that's to be encouraged, and we hope we'll see more of that. One of the features of the Fannie Mae website is something called Mortgage Affordability Calculator. It's a table where you can fill in various information items such as your income and expenses to determine how much of a home you could afford. So let's see what we can do here. We'll assume a monthly gross income of $7,000. Now you can change this. You can go online and put any amount here. And then there's various expenses that we can include. I'll have here a place here for a car loan. I'll assume right now no car loan. Your car is paid off. Maybe you have $100 a month credit card expenses. You may have more. If so, then fill that in amount. Maybe you have some other loan debts. Maybe there's some medical payments. Maybe there's student loans. Maybe there's some other type of installment loan payment. I've put 150 here. Again, you can put whatever you wish, whatever is appropriate. I've assumed that you could have a down payment of 10% for a new home. And let's assume interest rate and a 30-year fixed. With that information, we can see that you could afford a purchase price $347,960 for the price of the home, which would require a down payment of 10% of $34,796. Your mortgage loan amount would be $313,164, and your payment would be $2,270 a month for 30 years. Now, I want to point out something very important that may help guide you in your thinking for your expenses this year. Let's assume a car loan of, say, $500 a month. So we'll go over here to $500 a month. Now let's see what this, we'll still assume a down payment of 10%. We'll still assume other debts of 150, still assume an interest rate of 6%. But look what's happened from the previous amount of $347,000, almost $348, down to a new figure here of $260,965, just because you have a $500 a month car payment. Here's your new payment information. Your down payment would be less. 10% is applied to the purchase price. So if you're buying a less expensive home, you could have a lower down payment. Your mortgage loan now is going to be $234,869. You cannot afford as much of a mortgage as you did before, and so your monthly payment would now be $1,770. Because see, the mortgage companies will take into consideration all of your debts, including car payments. So one very important lesson from this: if you are very, very serious about buying your first home this year in 2026, don't buy the new car first. Buy the home first, and then worry about financing the car loan. Or make sure the car loan is paid off, because you can see there's going to be a substantial impact on the availability or the purchase price of the home that you can buy, depending on such things as just whether or not you have a car loan. And if your car loan was more than $500 a month, it would have even a greater impact. Again, to review, the maximum home that you could purchase with our assumptions, assuming a 30-year fixed mortgage at 6%, and if you have the car loan, the maximum purchase price is $260,965. Or I should point out, any other obligation, which would be $500 a month. Or if it's a different amount, fill that amount in. But I'm illustrating here how you can use this system. To better understand the importance of $500 a month for a car loan or some other purpose, let's examine just exactly what kind of debt $500 a month can support. Let's assume a car loan of 7% interest over a 7-year term. That $500, actually 501.24, can support a car loan of $42,000. But on a mortgage loan, assuming 6% interest, 30-year fixed, that $500 can support a mortgage loan of $180,000, more than 4 times the difference. So you can see why we saw a sharp difference in the amount of the potential purchase price of a home in our previous examples, whether or not you had a car loan. And if the car loan was more than $500 a month, the impact would be even greater. Bottom line, if you want to buy a new house this year, wait until after you get the home before you buy the car. Well, that concludes our program today. Please share this with other people who are possibly looking to buy their first home here in 2026. And as always, look forward to seeing you next time, where we will continue on our series here of with our guidelines for buying your first home in 2026.